Welcome back to the Deep Dive. Today, we're really getting into the weeds of how financial advisors figure things out. Not the products, not the policies, but the core logic, the math and the psychology behind deciding how much protection a person actually needs. Our mission is to look past the brochures and, really uncover the blueprint they use to build long-term financial security.
And that's the key word, isn't it? Blueprint.
Well,
It all starts with recognizing that this kind of planning is fundamentally about people. It's about their lives, their families, their ability to handle a sudden shock. A good advisor's job is to translate these very human situations, like having kids or a big mortgage, into real quantifiable risks. And then crucially, build solutions that are actually affordable. You just can't skip that first step.
right, understanding the client's deepest financial vulnerabilities first. So let's talk about that core idea, financial vulnerability. From what we've seen, every household really faces two kinds of risk. You have the predictable stuff, like retirement.
Or, eventually dying. It's going to happen.
Exactly. But then you have the unpredictable risks, the things like a serious illness, a disability, maybe losing your job. And the whole point of this planning process is to find where that client's financial resilience is a bit weak and then strategically shore it up. And that all starts with, as you said, a really deep fact find.
Absolutely. The fact find is non-negotiable, and honestly, it uncovers so much more than just income and outgoings. We're looking for the qualitative stuff, the relationships, the responsibilities, people's fears, what they hope for. You find out if someone is a huge risk taker or if they, lie awake at night worrying about the market. And that holistic view is essential because those feelings, those attitudes, they dictate how much risk a person is willing to carry themselves versus how much they want to hand over to an insurance company.
And this is where you start to see huge differences in priorities, right? I mean, let's make it real. A single person, no kids, maybe renting an apartment, their main worry is probably just income. How do I pay my rent and bills if I can't work?
Yeah, their focus is on lifestyle maintenance, simple income protection.
But then you contrast that with a couple. Maybe they've just bought a house, huge mortgage, and they have a new baby. Their focus completely shifts, doesn't it? It's not just about their lifestyle anymore.
Not at all. It becomes about capital preservation. The main goal is making sure that mortgage is gone and that there's enough money to replace an entire income stream for, maybe 20 years? Until that child is independent.
And what about the business angle?
Oh, that adds another layer entirely. A high-flying corporate exec might want protection that keeps their very specific, maybe high-cost lifestyle going,
Okay.
but a small business owner, their needs are doubled. They need personal protection, of course, but they also need cover that makes sure the business itself doesn't die if they get sick. So the advisor's skill isn't just typing numbers into a spreadsheet. It's listening. It's reading between the lines. It's about figuring out not just what the client says they need, but what they don't even realize they depend on.
So once the advisor has that whole picture of the client's life, how do they organize it? How do they structure all these different vulnerabilities into a plan that actually makes sense? I think this brings us to what our sources call the 4 pillars of protection needs.
That's right. These 4 pillars are basically a systematic way to look at every area of risk.
Okay, so pillar 1, and this feels like the big one, income security. For most people, their ability to earn a salary is their biggest asset. I mean, it's worth millions over a lifetime.
It really is, but it's so often the one that's least protected. It's a strange imbalance.
So how do you calculate how much income protection someone needs?
Well, there are 2 main ways. The first is a bit academic. It's called the human life value approach. It tries to calculate the total present value of everything a client would ever earn until they retire. It's a massive theoretical number.
That sounds a little overwhelming, to be honest. A bit scary.
It can be, yeah. And that's why most advisors today prefer the second method, which is simply needs analysis. It's much more practical. It just asks the question, what is the absolute minimum monthly income you need to cover your essential bills and maintain a decent standard of living if the money stops coming in?
So you're drilling right down into the deep.
You have to. You look at their employer's sick pay policy, how big their emergency fund is, their spending habits, every single debt payment. That calculation gives you the exact benefit you need from an income protection policy.
And how is that different from something like critical illness cover? People often get them confused, but they're structured very differently, aren't they?
Very differently, and they solve different problems. Income protection, or IP, that replaces your salary month by month, sometimes for years. It's about your capacity to earn. Critical illness cover, on the other hand, pays out a single tax-free lump sum if you're diagnosed with a specific serious condition, like a heart attack or certain cancers.
And that lump sum is for what?
For big one-off costs, to pay off the mortgage in one go, or cover expensive medical treatments, or maybe just to give a partner the financial freedom to take 6 months off work to help care for you. They're both triggered by illness, but they fix totally different financial holes.
That makes sense. And
Yep.
that leads us straight into pillar 2, family responsibility. Because once you have dependents, the financial fallout from something bad happening is it's exponentially bigger.
It is, because you're no longer just funding your own life. You're funding the entire household. An advisor has to look at the whole cash flow. Is it a dual income household where both partners earn about the same?
Or is one person the main breadwinner?
Exactly. If the family depends on one salary for, say, 80% of its income, the amount of life assurance needed has to reflect that huge economic gap that would be left. Life cover is there to replace all that future lost income, or to wipe out the big debts instantly.
Okay, let's move on to pillar 3, which is a lot less abstract. Debt exposure. Mortgages, car loans, business loans. These things don't just go away if you get sick or die.
They certainly don't. And here, the analysis is about the size of the debt, the repayment terms, and, frankly, the brutal consequences if you default.
So the protection here is very specific to the debt.
It should be. We usually see two main types of cover. For a standard repayment mortgage, where the amount you owe goes down every year, you'd recommend decreasing term assurance. The payout value of the policy falls over time, basically in line with your mortgage balance. It's very cost-effective.
And the other option.
That would be level term assurance. This is for when the financial need doesn't shrink. So if you have an interest-only mortgage, or if the money is meant for family income replacement, in those cases, you need the same size payout whether the claim is tomorrow or in 20 years. A good advisor matches the right tool to the right kind of debt.
And that leaves us with the 4th pillar, goals and aspirations. I like this one because protection isn't just about doom and gloom. It's about protecting the future you're working towards.
Absolutely. Think about saving for your kids' education or planning to retire a bit early. If a serious illness hits and you have to drain your savings and investments just to pay the bills, well, those long-term goals just vanish. They're gone.
Right.
So an advisor connects today's protection decisions with tomorrow's dreams. They might suggest adding indexation to a policy, for example.
What does that do?
It just means the value of your cover increases a little each year to keep up with inflation. It protects the real spending power of that future payout.
That's a really robust framework.
Yeah.
But, okay, once the ideal plan is on paper, you have to bring it back to the real world.
Yeah.
That brings us to things like context and, well, psychological barriers.
Yes. The first thing you have to do is look at what's already there. Most people have something, maybe a basic policy through work. The advisor's job is to audit that relentlessly. Is the death in service benefit, which is often just, 2 or 3 times your salary, is that really enough to replace decades of lost income?
Probably not.
Almost never. An old, small policy can create a really dangerous false sense of security.
What about the people who are really disciplined savers? The ones who say, look, I've got $100,000 in the bank. Why do I need to pay for insurance every month?
That's a huge one. And it's a moment for real client education. Savings are fantastic for short-term problems, but an advisor has to show them the math. With a serious health crisis, say a stroke that needs months of rehab, that $100,000 can be gone in a year, maybe 18 months once you factor in bills, medical costs, and zero income. Protection isn't a replacement for savings. It's the thing that protects your savings from a true catastrophe. It tones short-term flexibility into long-term resilience.
But getting that point across must mean navigating a lot of emotional resistance. It feels like you're selling fear. How do you do that ethically?
It's the essential tightrope you have to walk. The difference is in using data, not just dread. A good advisor anchors the conversation in facts and real-world examples. So instead of saying, you could get really sick, they'll say, government statistics show that X% of people your age will be out of work for 6 months or more. If that happened, your income loss would be Y pounds per month. Our goal is just to cover that quantifiable loss Y. You use empathy and clarity to empower them with knowledge, not paralyze them with fear.
But even the most perfect plan is useless if it puts someone under financial stress today. Affordability has to be the ultimate limit.
100%. The protection plan should never be the thing that causes the financial strain. Advisors have to prioritize. If money is tight, you focus on the highest risk area first. That's almost always income protection because your income pays for everything else. You might even stage the plan. Get the core life insurance now, and we'll add the critical illness cover in 2 years when you've had a pay rise. The plan has to be sustainable.
Okay, let's move into some of the more advanced stuff. We should really spend some time on clients with more complex finances, particularly business owners. Their needs go way beyond just personal cover.
They really do. For anyone who's self-employed or a company director, protection is also about business continuity. We're generally talking about three specific types of corporate protection.
Okay, break those down for us.
First up is key person insurance. This is vital if the business really depends on one or two individuals, the star salesperson, the genius coder, the founder. The company itself owns the policy and gets the payout. If that key person dies or gets seriously ill, the money is used to cover lost profits, pay off any business loans, and fund the search for a replacement.
So the business can survive losing its most important asset. What about the ownership itself?
That's the second area, shareholder or partnership protection. Imagine you have two business partners, 50-50. If one dies, their shares usually go to their family, maybe a spouse who has zero interest in running a software company.
That sounds like a nightmare.
It is. So this protection provides the surviving partner with the cash to immediately buy the deceased's shares from their estate at a fair, pre-agreed price. It keeps control of the business with the people actually running it.
That's incredibly important for stability. And the third one?
Business loan protection. This is simpler. It's just a policy that pays off any company debts or personal guarantees if an owner dies, protecting the business from lenders calling in their loans.
And we also have to touch on the fact that a person's lifestyle and health don't just affect their need for cover, they directly affect the cost and, well, whether they can even get it.
Absolutely. Underwriting is the final hurdle. An advisor must have a very frank conversation about smoking, any high-risk jobs or hobbies, rock climbing, private piloting, and of course any existing medical conditions. All these things increase the risk for the insurer, and that increases the premium. The key is transparency. You have to be truthful on the application, or you risk a future claim being denied.
It really sounds like the advice can't just be a snapshot of today. It has to look forward, maybe 20 or 30 years.
It has to. The plan must be flexible and adaptable. You should review it whenever there's a big life event, marriage, a new baby, a bigger mortgage, a promotion. And the focus changes over time. As you get closer to retirement, for example, your need for income protection might fall, but your need to think about long-term care planning starts to rise.
So we came into this deep dive, hoping to uncover that core methodology. And I think we've done it. We've seen that it's this blend of hard math, practical needs analysis, and a real understanding of human psychology and budgets.
I think that's the perfect synthesis. Protection planning is probably the most personal part of all financial advice. It forces you to see the whole person, their risks, their budget, their business, their dreams, not just numbers on a page. And when an advisor gets that right, they're not just selling a policy. They're providing genuine confidence and peace of mind.
And as we wrap up, I leave you with a final thought, built directly from everything we've discussed. If a person's income is consistently their biggest, yet least protected financial asset, what invisible hidden asset in your own life, maybe it's your health, your unique skills, or even just your ability to handle stress, might currently be exposed to an uncertain, unprotected risk? Thank you for diving in with us.